Good morning, everyone, and thank you very much for joining today's first quarter China update. I'm Darby Carstens, part of Prescient's business development team, and I'm joined by Tian Pan and Liang out in our China office. Liang is actually on leave. Tian is in our office, taking the time to talk to you guys today. Tian will very quickly run us through a market update as well as a fund update, and thereafter handing over to Liang to delve a bit deep into the fund. Tian, I guess everyone is very curious to know about life back to normal. We've been having it for a while. Zero COVID for you guys. The economy seems to be pumping. The equity market is running well, so we're all curious to hear what you have to say. As with all our webinars, just bear with us if there are technical difficulties. If you have any questions to ask, please post them on the Q&A function, and I will ask them to the gentleman at the end of the webinar. We will be sending out CPD certificates if you attended the full webinar. That will happen automatically. Tian, with that, I'll hand over to you.
Thank you, Darby, and morning, everyone. Thank you for taking the time to join us this morning. We are actually very excited to bring you guys the quarterly update on China. A lot has happened since we had our last webinar. I'm going to take everyone through a quick sort of on-the-ground update of what's happening. Just firstly, a quick recap of our products, our same sort of suite of products: China Managed, China Equity, and China Gear, which is a qualifying investors only. For our strategy, pretty stable in terms of AUM through a tough year last year. But with that, let me jump straight into the country update. And I think the theme for the first section is just bye-bye COVID zero. And I think sitting in February, a couple of months after the end of COVID zero in China, we almost can't remember what it was like in China back just 2 months ago when Liang and I just returned to China from our South Africa trip. But to show you guys how quickly things happen in China, as with everything. When Liang and I literally landed in China from South Africa, quarantine, inbound international passenger quarantine was shortened from 7 to 5 days. Not a big change at the time, but since then, within a span of 1 month, so by sort of early December, from about early November to about early December, every single COVID zero measure that was implemented domestically came crumbling down, and life pretty much went back to normal domestically, almost sort of pre-COVID-19 days by early December. By sort of late December, everybody in Shanghai at least seemed to have been infected and almost recovered. By the 8th of January, the international border fully opened. So the international border opened, but you still need to provide sort of COVID negative tests for travel. As of the 6th of February, a couple of weeks ago, no more COVID testing or proof of negative COVID test requirement would be required for travel between mainland China and Hong Kong. We expect further announcements to be made for overall broader international travel. So within a span of 2.5 months, 3 years of strict COVID zero measures have all been removed, and we are very excited about that. And markets also believe so. Liang will take you guys through the detailed numbers a little bit later. Just to show how the streets of Shanghai look like, this is an interesting slide. The photo is actually sort of on the main road in this sort of Chinese Shanghai's central financial district. During late December, everything was pretty much empty. So for those of us that were unaffected or recovered quickly, we really enjoyed the traffic-less roads of Shanghai. Infections were very high, very quick, given the high population density. So in a sense, it's tough when everybody was infected. And we did have restaurants closed due to shortage of staff, stores closing due to shortage of staff, but within a span of 2 weeks, everybody came back. And we think that's actually quite positive because everybody got infected and recovered much faster than we had anticipated. So the economy is actually in full swing now, with everybody pretty much back in action and the economy pretty much recovering towards full speed. We can see that in the PMI numbers, the latest services PMI numbers that were just released earlier this month, showing a strong recovery. You can see chart on the right-hand side. The gold line is the official China services PMI, and the blue line is the Caixin China services PMI. The difference between the two lines is that the blue line is more weighted towards small, medium enterprises. So it's actually very encouraging to see towards the right-hand side of the chart that even on the downturn, SMEs are actually more upbeat and less negative than probably your big state-owned enterprises in terms of just overall PMI figures. So with the recovery, both the gold and the blue lines recovered now above 50. So no more contraction. We had 4 continuous months of contraction prior to January, and we're very happy about the positive turn in the numbers. A lot of people are worried about Chinese property. We think with the latest round of developments, we don't expect Chinese property to grow at the levels they have been growing for the past 2 decades. But in terms of the fears of the entire sector collapsing, etc., we can see in a hard number source from the CRIC is that the decline is slowing and stability is returning into the sector. And there are a lot of government-backed policies, so government-backed bond issuances, more quotas for bank lending, everything, all the policies are there to ensure that the sector remains stable and does not collapse. But as we mentioned earlier, we don't expect to see the crazy levels of growth in the sector, but we do welcome the stability returning to the property sector. In terms of GDP number, for 2022, the official Chinese GDP growth number was 3%, well below the targeted 5.5%, but obviously with a lot of factors such as strict COVID lockdowns, unexpected lockdowns, etc. 3% is actually quite a good number given the year that we've had in China in 2022. In 2023, the average consensus for China's overall economic growth is around 5%. And that will be the fastest growing major economy in the world, China and India, actually. So this takes me to the next slide. These are IMF numbers. And these numbers are actually changing very, very quickly by these sort of global NPOs. So at the time we took the charts, the IMF's consensus estimates for China was a 4.4% economic growth. They have since revised number up to about 5%. India expected to grow around 6%. So China, with an economy the size of around $18 trillion, growing at around 5%, will be the major economy carrying global economic growth for the year of 2023. We can see the US with a 1% projected economic growth rate. There are many estimates that are below that number, some even predicting a recession. Europe and the UK is stuck around the 0 mark, slightly positive. So China is really going to be the standout out of the major economies, and that's pretty much agreed consensus for the year going forward. In terms of China-US relations, it's always a topical issue. It impacts market sentiment a lot. But as I've will mention, while we are, as Prescient as a team, we are very much on top of all the news and how it impacts markets. So just to give a quick summary, it's been a while. So 3 months ago, President Xi and Biden met at the G20 meetings in Indonesia. And I think the main point of that meeting was to halt the deterioration of bilateral relations, and it did just that, at least temporarily. But the tech war continues. The US continues to sanction tech companies, and we're well aware of the counters that the US sanctions affect. It's actually an extremely tiny portion of the stock market and a negligible portion of our portfolios. Politically, there's going to be quite a lot of noise. 2023, there's the provocative Taiwan Enhanced Resilience Act. There's a Defense Act that's very politically sensitive. But all of these issues are pretty much expected and largely priced into the market. And as I mentioned earlier, we are largely on top of it. So what we want to caution clients for this year going forward is that there will be a lot of market noise. There will be a lot of political noise. And a lot of it and almost all of it are expected. So we've seen spy balloon issues. We've seen sort of more tech sanctions. We will see a lot of political moves come through involving Taiwan. But the reality is that we need to focus on the chart on the right-hand side of this slide. Is that despite all of the tense political relationships, bilateral trade between US and just hit an all-time high in 2022. And bear in mind, that is with all of the restrictions of US companies, especially advanced semiconductor companies, unable to sell to China. So obviously the blue part of the bar chart is US exports to China, a lot less than US imports. But if these restrictions were lifted, we can see the bilateral trade growing even faster. But even under the tough conditions political conditions, we still see strong sort of trade growth between China and the US. So market noise, political noise expected to continue, but we as Prescient, as a quantitative house, we remain focused on the hard data on the ground, the earnings data, market data. So that's where we're focused, and that's what we use in terms of our portfolio positioning, which Liang will go through later. Veering away from the US, China continues to play the active foreign policy it has played since sort of the 20th CPC meeting that ended back in November. So just a few standout deals: China, Vietnam, long-term neighbors, and sometimes in political conflict, recently just signed 13 deals of an undisclosed monetary amount, but it's very significant given the two sort of regional rivals signing pacts to solidify supply chain resilience. China, Saudi Arabia, for the first time, signed 34 deals, trade and sort of intergovernmental deals worth at least $29 billion. So there's bilateral currency swap deals. It's also first between China and the major Middle Eastern economy. China, Qatar signed a record-breaking 27-year liquefied natural gas deal worth around $60 billion. And China, UAE cooperating in space missions. So with China and US trade sort of veering below sort of the 10% of overall Chinese trade, we are seeing China's focus again more and more with trading partners under agreements such as the RCEP trade deal and other regional and global economies. So that active foreign policy and trade policy definitely helps China diversify its economic exposure away from the US and making China-US relationship risk factor less and less impactful should something more significant happen in the future. And with that, I'm going to hand over to Liang to take everyone through the numbers.
Thank you very much, Tian. Right, as mentioned by Tian, I'll go through a little bit of the details. Apologize for the bad video quality and potentially audio quality. We finally opened up, so I've gone on holiday for just 1 week. So joining from the hotel room. Right, to start off with, 2022 was a year where most global markets struggled. We had a lot of bad news specific to China. We had the Fed hike, whether it's the S&P or the CSI or the HSCI or the Euro stock or Taiwan, pretty much everyone crashed quite a lot. South Africa is one of the best performing markets in the world, actually, with our commodity stocks really helping out over the period. The good news is that actually ever since the end of October, if you look at the last quarter or so, the Chinese market has actually gone on a massive rally. We've always said that the Chinese economy is always more resilient than what people believe it to be. It is an absolutely massive economy that's been very, very strong, that's been hobbled with a little bit of bad news from the different policy crackdowns that worried the markets to potentially never-ending COVID zero policy that could have dragged out the restrictions for far longer. We didn't even expect this thing to open up so quickly, but given the speed of its opening up, the end result is that since the end of October, the HSCI market is up 51%, the Chinese market is up 28%, and the S&P over that period is only up 6% over the exact same period since the end of October. And that comes from just having some of the bad sentiment. HSCI at that point in time, October, was the most shorted market in the world and the most shorted in the entire history of its existence. At that point in time. So the recovery is not that much of a surprise. What people would answer themselves is that, well, has it recovered too much? Is it too fast? And the good news to that is that we can say that since its recovery has only just begun, because the market was fallen so deep that just to recover back to its 2021 highs is a recovery of up to 40 to 60% from current levels. So the market is still, although has recovered a lot and the recovery path won't be smooth, has a lot to go on its recovery. One example I always point out is the Great Financial Crisis. It crashed all the way in March 2009. The S&P was 666 points or 676 points at that point in time. And by 2010, January, a couple of months later, the S&P was back over 1,000 points. And people also worried, has that recovery happened too quickly? And of course, we all know that recovery went on for another 7 or 8 years, although it is very choppy, especially in the beginning part of the recovery. There's lots of big swings in the market, but overall, the recovery will heal itself and take time. And the good news of it is also the P ratio looks extremely cheap. So here I am not using HSCI, but using MSCI China's P ratio to MSCI All Country World Index P ratio. And what it shows is how MSCI China is at a massive discount relative to MSCI All Country World Index currently. So some people often question, well, should it always be at a discount? Number one, you can see from history that no, there are a lot of periods where it's actually more expensive than the overall market. And secondly, also what people also maybe have to realize, a lot of people are worried that when you buy HSCI, for example, you're buying a lot of the old world market, right? And that's true 5 to 10 years from now. So 5 to 10 years ago, on the left-hand side, what I have is a different sector breakdown of the HSCI. And you can see that in 2015, that entire index was made up of 71% financials and 11% energy, essentially big state-owned financials and oil companies in China. If you take a look at today, in 2023, January, 40% of that index is now IT and tech-related stocks. Financials only make up 24, consumer discretionary, the next biggest, with 11%. So there's a dramatic change in the makeup of the index, yet the P ratio is close to its all-time low. It's no longer a state-owned enterprise index, and it still remains an index that's priced for the collapse of China and not even just growing China. Right. In terms of global valuations, I mean, the H shares remains extremely, extremely attractive. Hong Kong listed stocks are, after the recent 50% rally, are only looking at a PE of 6 to 7, high sixes, low sevens. Of course, it will take time for the earnings to recover as the Chinese economy recovers coming out of all these things. Earnings are only going to start recovering in June, potentially September, even the December quarter. But we do believe that the market will be ahead of that. So the opportunity right now is actually very, very good, given everything else. All right, looking on further into the details, inflation wasn't an issue in China, remains not an issue in China. Inflationary pressures, when we measure it, are quite low. And the end result is that Chinese interest rates are quite low. So unlike the US, where interest rates are 4.5, and can potentially stay there for a while, Chinese interest rates are currently only between 2 to 2.5%, and currently has no pressure to hike. So this should also help the recovery of both economies and potential sentiment and valuations of the market. If you look at Prescient economic model, it's no surprise that our economic activity indicator still looks horrible at the moment. Given that it's backward looking, the latest released economic data is still January data. In January, we had Chinese New Year's, so we essentially only had around 2.5 weeks of work time. And of course, the COVID wave only ended early January, so we potentially only had 1.5 weeks of work time. But the really good news is that we don't see any inflationary pressures. As such, monetary policy can remain easy, and faster moving indicators and our own experience on the ground does indicate that the economy is recovering very, very strongly. Ever since the lockdown in March last year in Shanghai, for example, in our office block, restaurants has never been full. So you could always just go get a seat. In early January or mid-January this year, you can no longer get a seat. Every single restaurant is full. So certainly, even on an anecdotal level, we're seeing that the economy is recovering very, very strongly in China. Right, in terms of our performance, so a few big things that's happening in our fund that I think is quite exciting. So the first thing is that our sentiment model has gone 100% positive for the first time in 18 months. So since May 2021, our sentiment model has never been that bullish Chinese equities. It went from 100% negative to, let's say, 50% positive or slight recovery, but it's never been to 100% positive. And I think we're really encouraged that our sentiment model, which is designed to be quite fast moving, so sometimes can give false signals, but it's designed to be fast moving, has recovered so quickly, even though the market is still around 50% lower than its historic highs. So that's a really, really good sign that we see. In October, we came through and we said, look, we saw the biggest opportunity in investment grade bonds we've ever seen in the history of China. For the first time, they're pricing credit risk right. And we were hoping to hold on to these high yield bonds for years. However, in November, the entire extra credit spread just disappeared. So all these bonds recovered, and we were able to make a profit that we expected to make in the future years in literally 1 month. Within 1 month, all the investment grade credits have recovered. In October, we also spoke about putting derivatives in place, where the core of our investment, around 60% of the exposure is in mainland China, and the other 40% via derivatives allows us to get us exposure to these Hong Kong stocks, which are more volatile, a little bit riskier, highly tech concentrated, but still with limited downside. And by executing on those plans into our fund, it's really, really helped our performance over the past year. So if you look at our performance over the period, for example, the blue line there on the left-hand side is our fund from December 2021, and the red line is the market. And October is where we highlighted the market. So from January to October, when the market's down 26%, we were down 17.7%. So we had about 67% of the downside. But from October to currently, the market is up 17.1%. We're up 17.4%. And the net result up to the end of December 2022, sorry, not 2021, on the full period, is that the market is down 13.8%, but our fund is only down 3.45%. We managed to get 67% of the downside with almost 100% of the upside. And that's really what we target and the value add we bring to our clients by investing with us. And over the long term, this value add is what makes our fund really, really strong. The yellow line is our inflation, the yellow line is our China Balance Fund A class, and the blue line is 65-35 equities fixed income, and the pink line is CSI 300, the 100% market. And as you can see, over almost the past decade that we've been invested in China, we've beaten both 65-35, we've beaten 100% equity, we've beaten inflation +3 comfortably, and at the same time, to a total return, we almost doubled the total return of the 65-35 composite return. And I think that's what we see, and we think currently, off these bases, it's also a very attractive time to invest in China. Competitively, we're also doing very, very well. We are 5-star Morningstar rated, and we're extremely competitive within our peer group, with over 4,000 funds, top 5% globally, top 20% over the last 5 years. And 5 years ago, we were also close to a market peak. Right, so I'll end there and open up for questions. To summarize, I think one of the things we've seen that's really different from before is our sentiment model going 100% positive. That hasn't happened. It's the first time in 18 months, so that looks quite good. Valuation remains attractive in spite of a very fast recovery over the last couple of months. The economy is healing and recovering fast. We are currently maximum overweight in the portfolio for our equities. Our fixed income is largely in risk-free assets where they are. We still make use of derivative to gain the upside exposure to Hong Kong shares while limiting a little bit of the downside within the risky portions of the market. And we'll continue to dynamically manage asset allocation. I think for us, the market is recovering and cheap. And it's a type of market environment where we will be maximum overweight in equities. For those who know us for a long time, we always say the time we really like equities is when markets are cheap, sentiment are recovering, and policy is helpful toward the equity market. And I think very, very rarely are the three in the same direction. And I think for the first time in a very, very long time, we're seeing that in China. Okay, I'll end there and open us up for questions. Thank you very much.
Thank you, Tian and Liang. There's a couple of questions coming through here, so let's see how many we can get to. Tian, maybe the first one for you, the reversal of the COVID policy, was that due to potential unrest, sort of the risk of that increasing, or what would you attribute that to?
I think that's the media reports. I think it falls part of the market noise factor. So the protests that were widely reported in English media, and very isolated small incidents that were probably partially COVID-related. So we don't believe there's going to be risk of unrest on the ground here in China. So everything is pretty stable, especially after the economy is fully back up and running. I think, yeah, risk of unrest, absolutely minimal. And the reversal of the COVID policy, we think it was definitely due to many factors. So economy, youth unemployment, etc., that we covered on our previous webinars. So we do think the government considered various factors and the timing or so on to the TPC. So it's difficult to attribute it to one factor, but overall, as we said, we very much welcome the quick sort of policy change and the very quick sort of infection and herd immunity position that we have now.
Maybe I'm going to stay with you, yeah?
Sorry,
Liang?
David, to add to that, I think, of course, never forget, it's also because Omicron spread. So if the previous policy was 100% successful and easily done, they would have stick to it. And one of the things was that we had a little bit of protest, economy was slow, everything was happening, but at the core of it also, the disease itself was less deadly and it also spread. So what's really good to see for me is that number one, that the government, I think, changing the COVID zero, right, is a surprise to everyone. Because if you recall when Xi Jinping got his third term, everyone was like, well, there's no one stopping him now. You know, he can just do whatever he wants, right? And I think what's really good to see that they do look at, you know, what's happening in the market. It's not just something that, you know, they just apply and never change their mind, right? They look at how's the disease doing, what's happening with the disease, how do the people, you know, are reacting to these policies. I think a combination of all these factors results in the change.
Thanks, guys. Maybe, you know, stay back to you, Tian. So the China Balance Fund is priced in dollars. Should the rand dollar be a consideration when considering investing in the fund? And maybe to widen a little bit more, where would the fund China be suited for a South African investor? Why would it be suited to a South African investor?
So I think definitely to answer the first part of your question, we do have the underlying Prescient China Balance Fund is priced in dollars. So I think a lot of our clients invest via the Prescient China Balance Feeder Fund that's priced in rands, but the underlying you get dollar exposure. So if the rand depreciates by 10% today, if nothing changes in China, your rand unit price will increase by around 10% as well. So it's a rand hedge, definitely. In terms of overall allocation, diversification, both in terms of sort of currency and equity. So obviously being priced in dollars with underlying assets in CNY, which is semi-pegged to the dollar, it's a natural currency rand hedge. And then secondly, from our historical back testing, the Chinese equity markets, especially mainland China, not so much MSCI China, but where we are in terms of equities, CSI 300. That is, out of all the major equity markets historically, one of the best diversifiers for South African investors who typically have South African equities as core of their holdings. So typical historical correlations anywhere between 25 to 40%, much lower than your MSCI emerging market correlation, which sometimes hits 80%, given the historical sort of test that we've done. So overall, we think it's a great diversifier for sort of equity and overall portfolio diversification as well. And typically the optimal, especially given the increased rate 28 allowances of up to 45% offshore. Typically in terms of the South African-based portfolio, the optimal risk return sort of diversified allocation to China is around 15%. We do realize, given sort of capital control restrictions in SA and not fully having access to a global portfolio, 15% is a bit much, but anywhere from 5% or does make an impactful statistical difference from a portfolio sort of risk return basis. So that's where we would recommend clients to start if they haven't already got an allocation to China as part of their South African-based global portfolio.
Thank you. You touched on sort of Hong Kong and mainland. How would the tech restrictions impact our funds? Maybe also elaborate on the differences between the H shares and the A shares, Hong Kong, CSI 300.
Liang, do you want to start on that one?
Sure, I can add a little bit to that. So number one is that so far the restrictions are mostly targeting kind of companies linked to the Chinese government or companies linked to, let's say, the military of China. So far, the restrictions had a very, very small impact on our overall portfolio. In fact, even without doing any changes, our portfolio are probably impacted by less than 1% in the sanctions and restrictions we have. What we do think will happen over the longer term is that China itself will develop a lot of technology that previously purchased from the West, and that'll increase competition around the world. So what it means is that tech companies in general, not just Chinese tech companies, but Chinese and Western tech companies' profitability should be impacted, whereas previously profitability will be much, much, much higher. Now going forward, it'll be a little bit lower. If you look at shares listed in China and shares listed in Hong Kong, historically there were big differences. So historically, you had most private enterprises finding it easier to list in Hong Kong than listing it in China. But over the years of reforms and decades of opening up, these differences are becoming more blurred. In general, what we can say is that all the major tech companies typically are exclusively listed in Hong Kong and the US, or everything else is mainly listed in mainland China. And one of the reasons behind that is also historically, companies have been able to get a higher valuation inside the US rather than China. Of course, this is no longer the case. The valuations has come down overseas now. So as I mentioned, the differences are getting smaller and smaller over time. What I can say is that access to the mainland shares give you a lot more than just tech and consumer. So you're massively into tech and consumer. A couple of years ago, we would never touch those indices because we always say they're highly concentrated, highly risky. They're great companies. They're just expensive and highly risky. Whereas today it's different. Today we're like, wow, this is the cheapest we've ever seen in the entire history, cheaper than all similar companies around the world. So the investment case is quite different. However, in terms of actual differences, they're shrinking over time, and going forward, they'll shrink even more.
Thank you, Liang. A couple of questions with regards to the property market, consumption of commodities, some specifically referring to iron ore. So I guess maybe speak a bit about the property market and the after effects of commodity consumption.
Very, very good question. So I think the core of what we see is that the Chinese government is going to bring stability to the property market, but not another bubble. So everything we've seen and every policy document they've sent out and everything they've done point to the same direction, that they want a sustainable, slow-growing market, not a fast-growing one. So I think in any core investment thesis you guys make, I mean, we're not investment specialists, but any core investment thesis, I think a reasonable assumption going forward is that Chinese property as a sector will grow slower than overall Chinese GDP. And I reiterate that. So historically, the growth of Chinese GDP is concentrated a lot in the property sector, but that's in China's past. Going forward, I do expect over the next decade or two that this entire dynamic will reverse. And that trend is not going to change anytime soon. Having said that, the sector is extremely sold out. Everything's very, very cheap. But then commodities are not, right? Commodities are actually very, very expensive. So that's a very interesting one. I would say there'd be some risk there. There could be other reasons why commodities rally. It can have nothing to do with Chinese property sector per se. It could be infrastructure build. It could be the US resurging infrastructure investments. It could be inflation. It could be a lot of other reasons why commodities will rally. But I don't expect the Chinese property market to be the major contributor of a sudden increases in purchases in commodities for construction.
Thanks, Tian. Maybe staying with you, if the China recovery remains strong, but the US and Europe go into recession, what would the net effect be at a global level? And how would you see this play out?
I think it's actually the net effect would be better than if China was still in COVID zero. So I think if you look at late last year, one of the scenarios that could scare everyone is that as the US hike and hike and hike, the US goes into recession, Europe is skirting, barely getting by a recession. And if China continued with COVID zero, you had a China that is growing very slow and bad sentiment, right? That would have caused a global recession, which is very scary. I think if you look at the picture today, the US seems to, if we do have a recession, hopefully a very shallow recession, Europe in a similar picture, and China is actually recovering. So that will be a great offset to the rest of the world. If China can maintain its economic performance, which we expect to do. I think everyone has seen China has had record saving in 2020, record saving. So China usually saves 17% of their income, which is insane. So the number for South Africa is like 0 or -1%, and China was at 17. But last year it went from 17 to 30, right? So people really didn't spend. And the COVID zero policies have a very serious impact on the sentiment on the average man and woman on the street. I mean, that's the reality. The restrictions make people unhappy. And with it all gone, in spite of everyone getting sick, and there will be extra deaths, there will be all of that. But in spite of that, for most people, it was a mild infection that they recovered from reasonably quickly, and as such, has actually boosted sentiment a lot in on the ground for the economy.
Maybe a last couple of questions. Tian, Liang, you guys can decide who takes this one. How do you think the aging of the Chinese population and the distorting effects of the one-child policy play out over the medium and long term?
Okay, I'll do the one-child policy one. I think globally, as every nation gets wealthier, birth rates just drop like a rock. So if you look at Japan, if you look at South Korea, if you look at all of Western Europe, even if you look at the USA, birth rates around the world has just dropped dramatically. I think what's luckily for us as a human race, that automation is also rising dramatically. So I think the one-child effect has been stopped, and now we have no restrictions in China, but it's not helping the birth rate. I think in general, most children are surviving, so people find less and less reason to have multiple children. And secondly, it's extremely expensive to raise a child. The world has gotten to a stage where everyone knows that if you're working, it is actually very, very difficult to raise a child. It's a massive sacrifice to raise a child. So I think that's not going to change. But luckily, demographics happen over a very, very long time, very, very slowly. And every single country in the world will have to make policies to adjust for that. So France recently, increased the retirement age, and they had riots all over France. China, similarly, over the coming years, will have to slowly, they already do. Yeah, every year, the retirement age increases by a couple of months. So all of these things are kind of both priced in, and government policy is adapting to an aging population.
Okay, thanks. Last question. I guess we are bombarded by Western media, the US-China relations, so a couple of questions with regards to that. Maybe to summarize it, the economic indicators are pointing to a resurging Chinese market. How concerned should an investor be of the China-US relations in the near to medium term?
I'll let Tian answer that.
Oh yeah, I think as I mentioned earlier, I think the key factor is market and political noise. So there are a lot of things happening in sort of US Congress, in terms of foreign policy, in terms of sort of media reporting. Can everyone hear me clearly? I think I'm a bit blurred. Just let me know if you guys can't hear me clearly. But I think in terms of concern, we're not too concerned because everything that's happening or that's expected to happen in 23 and part of 24, there's obviously elections coming up in the US, and you typically have certain expectations that we believe many of these things, firstly, are not necessarily that impactful on markets. So, for example, the tech sanctions, like Liang mentioned, on a lot of the sort of leading edge tech companies in China, a lot of the companies are either unlisted. For example, Huawei is the highest profile unlisted company, and other companies, many which are unprofitable. And from a portfolio perspective, we typically have very little, mostly zero exposure to those companies. Secondly, a lot of the political incidents actually make more noise than they do have tangible impacts. Unlike what the media headlines try to portray, it's definitely not the end of the world in terms of China-US relations. As the slide earlier showed, China-US trade is still hitting an all-time high, even given the tough relations. So the practical interaction between the two economies continue to happen and continue to grow. And its impact filtering through to the market should still be positive over the long term. And we're fairly confident that the two countries should find balancing points to engage with one another going forward. So we're quite comfortable in that sense. And right now we don't see any major issues that should be of concern. but obviously we continue to monitor the relations and along with its tangible market impacts as they develop.
Thank you, Tian, Liang, for your time. Thank you, everyone, for attending today. I hope everyone found today insightful, and we'll speak to you at the end of the next quarter. Have a great week further. Bye.